about this not being completely normal in terms of business as usual and maybe dip buying or however you want to approach this as an investor. We are going to retest some of the lows. Maybe it looks like we're doing it already. You still think at this point that there may be a likelihood of more work on going down than there is on rebounding?
I'm afraid so, Joe. I think you've got three things going on. And this is after you simplify all the complexity. One is the economic of sudden stops, when activity comes to a halt. Two, the economics of fear, when you amplify all this through human reaction. And third, what's going to happen to the trust we've had in the central bank anchor, in the central bank backstop? All three of these things are in play right now. I would be, if I'm a long-only investor, I would be careful. I think you're going to have opportunity in distressed, in special situations, in relative value, in arbitrage. But be careful if you're a long-only investor at this point before you go in and pile on more risk.
We've gone back and forth in your long career. Did you ever give credence? Did you ever give 20% credence to technical analysis, Mohamed, or do you always try to just base things on fundamentals?
Oh, I absolutely do. I think in markets like this, and that's why at the beginning of the week when you had me on Monday, I said this is going to be extremely volatile. If you're a day trader, you're going to have fun this week. Oh, absolutely. There is a massive tug of war going on in technicals. There are technical levels being breached. This is a fascinating market that is trading on technicals, but the underlying fundamentals aren't stable as yet, Joe.
Mohamed, you said, it's Steve here, you said you'll have opportunities in distressed debt. That's like one of the yada, yada, yadas. Let's explore opportunities in distressed debt. That means bankruptcies, that means defaults. What do you think? I mean, it's not like I want to pile on the bad news that's out there, but you did write a column the other day about the possibilities of the potential fallout in the fixed income market. So talk us through the possibilities here and the probabilities.
Look, for a long time, we've had such low interest rate that the right thing to do if you're a company was to change your capital structure by putting on more debt. So we have a massive overlay of BBB minus companies that are hanging over the high yield market. We're looking at a major economic slowdown. That's going to increase credit risk. That's going to increase downgrades. We're going to have downgraded fallen angels coming into high yield.
Right.
It is not clear.
I'll just interrupt you real quick. BBB minus is the lowest rung of investment grade. And so when you, if I'm not mistaken, so when you say an overhang, you mean there's a ton of stuff right here that if things change, they cross the line, they breach the barrier and become junk. I'm sorry to interrupt, but I just want everybody to understand that.
Yes, and the size of the high-yield market, its ability to absorb what's coming down in the short term is limited. So that disrupts that market, which then disrupts primary issuance. So if you're an airline, if you are an energy company and you're looking to refinance your debt, it's going to be more difficult. And that's where there'll be opportunity for those who can provide very focused financing, get it securitized, and this would actually be a golden opportunity for investors.
Hey, Mohamed, we're running out of time, so real quick, when I look at the market and when you see this selling that's taking place through the systems, I'm never seeing buying of value stocks anymore. Is value dead for all apparent purposes? Because whenever the market rallies back, they buy tech again. But we're looking at these value names. Is it because the chemical names and the energy names are under the umbrella of this outsized ESG focal point for the market?
Yeah, I think you've got these other big changes going on that are changing preferences and tilting preferences in exactly the way you just cited, and you've just got to respect that.
Guys, I want to just come back to what Mohamed said as we think about this idea of finding a bottom. I don't think you find the bottom until you understand what's going to happen to the capital structure of some of these companies, right? So there's going to be smart money that's going to wait on the sidelines for a better deal, and that better deal could happen in a default or distress situation, and that's when I think when that clarity comes through. We talk about
And if I
strong
can
hands.
add something.
Go ahead, strong hands and weak hands. The strong hands may be on the sidelines waiting for a better deal.
And if I can add something,
Yeah, go ahead.
let's not urge the central banks to cut rates for the sake of cutting rates. That is a very, very blunt instrument. Let's urge the central banks to look at the functioning of markets and focus on where there is liquidity distress, because the last thing we want is a feedback loop from disrupted markets onto the real economy. So rather than use
Go ahead.
rather than use a blunt instruments, they should be really laser focused.
I just want to point out the 10-year yield was just at 0.739%. That continues to fall, and that
700.
continues to put additional pressure on the Dow, which is now down by over 700 points this morning. Mohamed, thank you. Great to see you.
Coming up, an update on the coronavirus outbreak. At the top of the hour, Secretary of State Mike Pompeo